Business Economics, Unit 3, Business Concepts. What is incremental concept in economics? The incremental concept in economics refers to the idea of analyzing changes in economic variables or outcomes by focusing on the additional or incremental impact of a specific decision or action. It involves examining the marginal effect of a particular choice on costs, revenues, or other relevant factors. For example, in the context of production, a firm may use the incremental concept to determine whether to increase its output by comparing the additional revenue generated from selling one more unit of a product to the additional cost incurred in producing that unit, which is marginal revenue and marginal cost. The firm can assess whether the incremental benefit outweighs the incremental cost. If the marginal revenue exceeds the marginal cost, it would be economically efficient for the firm to increase its production. Differentiate incrementalism and marginalism. Incrementalism and marginalism are both concepts used in economics to analyze decision-making processes, but they have distinct meanings and applications. Incrementalism. Incrementalism refers to the approach of making decisions or changes gradually, often through small adjustments or increments, rather than through sweeping or radical transformations. In the context of policy making or planning, incrementalism involves making adjustments to existing policies, programs, or strategies based on small-scale changes in circumstances or objectives. Incrementalism acknowledges the limitations of complete information and the complexity of decision-making environments, often favoring pragmatic and adaptive responses over rigid planning. Example: a government might implement incremental changes to tax policies by adjusting tax rates slightly each year based on changes in economic conditions and revenue requirements, rather than overhauling the entire tax system in a single reform effort. Marginalism. Marginalism, on the other hand, focuses on analyzing the incremental or marginal effects of a specific decision or action on economic outcomes. It involves examining the additional benefits or costs associated with producing or consuming one more unit of a good or service. Marginal analysis is often used to determine optimal levels of production, consumption, or investment by comparing marginal benefits to marginal costs. Example: a firm might use marginal analysis to decide how many units of a product to produce by comparing the additional revenue generated from selling one more unit, which is marginal revenue, to the additional cost of producing that unit, which is marginal cost. If the marginal revenue exceeds the marginal cost, the firm would increase production up to the point where marginal revenue equals marginal cost. In summary, incrementalism emphasizes gradual change and adaptation in decision-making processes, while marginalism focuses on analyzing the incremental effects of decisions on economic outcomes, particularly in terms of marginal benefits and costs. What is discounting principle in managerial economics? The discounting principle in managerial economics refers to the practice of assigning lower value to future costs and benefits compared to those occurring in the present. It is based on the concept of time preference, which suggests that people generally prefer to receive benefits sooner rather than later and incur costs later rather than sooner. In practical terms, the discounting principle is used to determine the present value of future cash flows or costs. This is important in decision-making processes such as investment appraisal, project evaluation, and capital budgeting, where managers need to compare costs and benefits occurring at different points in time. The principle of discounting recognizes that a dollar received or spent in the future is worth less than a dollar received or spent today due to factors such as inflation, opportunity cost of capital, and uncertainty about future outcomes. Therefore, future cash flows or costs are discounted back to their present value using a discount rate, which reflects the time value of money and the risk associated with future cash flows. By discounting future cash flows or costs to their present value, managers can make more informed decisions about allocating resources, investing in projects, or evaluating the profitability of business opportunities. The discounting principle helps ensure that future benefits and costs are appropriately considered in decision-making processes, taking into account the timing and risk associated with those cash flows. What is opportunity cost? Opportunity cost is a fundamental concept in economics that refers to the value of the next best alternative foregone when a decision is made. In simpler terms, it represents the benefits or value that could have been obtained by choosing an alternative option instead of the one that was chosen. Here is an example. Imagine you have $20 and you are trying to decide between buying a book or going to the movies. If you choose to buy the book, your opportunity cost is the enjoyment or entertainment you could have gained from going to the movies instead. Conversely, if you choose to go to the movies, your opportunity cost is the knowledge or satisfaction you could have gained from reading the book. Opportunity cost is not always expressed in monetary terms. It can also include factors such as time, resources, and other opportunities foregone. In business and economics, understanding and evaluating opportunity costs is crucial for making informed decisions about resource allocation, production choices, investments, and trade-offs between competing alternatives. Define equi-marginal principle. The equi-marginal principle, also known as the principle of equi-marginal utility or the law of diminishing marginal utility, is an economic concept that states that a rational decision maker will allocate resources in such a way that the marginal utility, which is satisfaction or benefit, derived from the last unit of a good or service is equal across all possible uses or allocations. In simpler terms, the equi-marginal principle suggests that when allocating scarce resources, such as time, money, or effort, among different options, individuals or firms should continue allocating resources until the marginal utility obtained from each option is equalized. For example, imagine you have $10 to spend on two goods, hamburgers and pizza. If you derive 10 units of satisfaction from each dollar spent on hamburgers and 8 units of satisfaction from each dollar spent on pizza, you should allocate your money in such a way that the marginal utility per dollar spent on hamburgers is equal to the marginal utility per dollar spent on pizza. By applying the equi-marginal principle, individuals and firms can maximize their overall satisfaction or profit by efficiently allocating resources to achieve the greatest possible utility or benefit. What are problems of all economy? One of the fundamental problems that all economies face is the issue of scarcity. Scarcity arises because resources are limited, while human wants and needs are unlimited. This leads to the need for societies to make choices about how to allocate their scarce resources efficiently to satisfy as many wants and needs as possible. An example of this problem can be seen in healthcare systems around the world. Healthcare resources such as medical personnel, equipment, and facilities are limited. However, the demand for healthcare services is virtually unlimited, as people will always seek medical treatment for various illnesses and conditions. This creates a situation where healthcare systems must make choices about how to allocate their limited resources among competing healthcare needs. For instance, they must decide whether to invest more resources in preventive care, specialized treatments, emergency services, or research and development of new medical technologies. These allocation decisions involve trade-offs and may result in some healthcare needs being met at the expense of others, highlighting the challenge of scarcity faced by all economies. Explain scarcity of choice. In economics, the concept of scarcity of choice refers to the limited availability of options or alternatives relative to the unlimited wants and needs of individuals and societies. It highlights the fundamental problem of scarcity, where resources are insufficient to fulfill all desires, necessitating choices to be made about how to allocate these limited resources among competing uses. An example of scarcity of choice can be found in the realm of education. Consider a scenario where a government has limited funds available for education. With these limited resources, policymakers must decide how to allocate funds among various educational programs and initiatives such as primary education, secondary education, vocational training, higher education, and adult education. Given the scarcity of resources, policymakers must make difficult choices about which educational programs to prioritize and allocate funding to. For instance, they may need to decide whether to invest more in improving the quality of primary education to ensure all children have access to a basic level of education, or allocate funds towards expanding higher education opportunities to support economic growth and innovation. Additionally, policymakers may face trade-offs between different objectives within the education sector, such as improving infrastructure, enhancing teacher training, providing scholarships and financial aid, or investing in educational technology. Each decision involves an opportunity cost. By choosing to allocate resources to one area, policymakers forego the opportunity to invest those resources elsewhere. In this way, the scarcity of choice in education exemplifies how limited resources force individuals and societies to make trade-offs and prioritize certain options over others, highlighting the fundamental economic problem of scarcity. Business economics is economics applied in decision-making. Explain. Business economics, also known as managerial economics, applies economic principles and concepts to business decision-making processes. It involves using economic analysis to understand and solve real-world business problems such as pricing strategies, production decisions, investment choices, and resource allocation. One key aspect of business economics is the application of microeconomic theories and tools to analyze the behavior of firms and markets. For example, concepts such as supply and demand, marginal analysis, cost-benefit analysis, and market structures are used to evaluate business decisions and strategies. Let's consider an example to illustrate how business economics is applied in decision-making. Imagine a manufacturing company that produces smartphones. The company is considering whether to invest in a new production technology that would increase the efficiency of its manufacturing process. However, implementing this new technology would require significant upfront investment. To make an informed decision, the company's management team would use principles of business economics to analyze the costs and benefits associated with adopting the new technology. They would conduct a cost-benefit analysis to compare the expected costs of implementing the technology, such as equipment purchases, training costs, and installation expenses, with the expected benefits such as increased production efficiency, reduced labor costs, and potential revenue gains. Using techniques from business economics such as discounted cash flow analysis, the management team would estimate the present value of the costs and benefits over the expected lifespan of the technology. They would then evaluate whether the expected benefits outweigh the costs and whether the investment aligns with the company's overall strategic objectives and financial goals. Additionally, the company would consider market conditions, competitive factors, and regulatory environment in their decision-making process. For instance, they might analyze market demand for smartphones, competitors' actions, and government policies related to technology adoption and industry standards. By applying principles of business economics, the company can make well-informed decisions that enhance profitability, competitiveness, and long-term sustainability. Business economics provides a systematic framework for analyzing complex business problems and identifying optimal solutions based on economic logic and evidence. Discuss the nature and scope of business economics. Business economics, also known as managerial economics, is a branch of economics that applies economic theory and quantitative methods to analyze business enterprises and the factors affecting their decisions. It involves the application of economic principles to various aspects of business management, including decision-making, resource allocation, pricing, production, and market strategy. Here is a breakdown of its nature and scope. Decision-making. Business economics helps businesses make informed decisions by analyzing costs, benefits, risks, and trade-offs. For example, a company might use cost-benefit analysis to decide whether to invest in new technology or expand its product line. Resource allocation. It deals with the efficient allocation of scarce resources such as capital, labor, and raw materials to maximize productivity and profits. For example, a manufacturing firm might use economic models to optimize its production process and minimize costs. Pricing strategies. Business economics provides insights into pricing strategies, including cost-plus pricing, demand-based pricing, and price discrimination. For example, an airline might adjust to ticket prices based on demand and competition to maximize revenue. Market analysis. It involves analyzing market conditions, demand, competition, and consumer behavior to identify opportunities and threats. For instance, a retail company might conduct market research to understand consumer preferences and tailor its products accordingly. Risk management. Business economics helps businesses assess and manage risks associated with various decisions such as investment expansion and pricing. For example, a financial institution might use economic models to evaluate the credit risk of loan applicants. Regulatory environment. It considers the impact of government policies, regulations, and taxation on business operations and strategy. For instance, changes in tax rates or trade policies can affect a company's profitability and competitiveness. Globalization. With increasing globalization of markets, business economics also encompasses international trade, foreign exchange markets, and multinational corporations. For example, a multinational company might analyze exchange rate fluctuations to optimize its international operations. Sustainability. In recent years, there has been a growing focus on sustainability and corporate social responsibility in business economics. Companies are increasingly considering environmental and social factors in their decision-making processes. For instance, a manufacturing firm might invest in green technologies to reduce its carbon footprint. Overall, the scope of business economics is broad and dynamic, encompassing various aspects of business management and strategy. Its interdisciplinary nature draws on concepts from economics, finance, accounting, and other fields to provide insights into real-world business challenges and opportunities. Happy learning!